day. I welcome you to the Duahbed Consult platform once again. We are coming to continue from where we ended in our last sessions and our accounting for oil and gas. So today we are coming to learn about how to account for overlift and then underlift. So in oil and gas accounting, sometimes two or more entities come together to form a joint venture. Thus, both entities will contribute capital into the operations. So whatever that will come out from the operations will be shared among the entities according to amounts of capital that they have invested in the activities or operations, or according to their profit and loss sharing agreement. So that's underlift and overlift. So underlift occurs when an entity takes less than what it's supposed to take from the activities of the organization. And then overlift to occurs when an entity or a partner takes more than what is supposed to take from the activities or operations of the organization. So for example, let's assume that A and B have entered into a joint venture, and then A is entitled to 70% of the drams or barrels of oils that they will produce. And then B is also entitled to 30% of the barrels of oil that they will produce. So in case the number of barrels of oil that they produce during the year is 100 barrels of oil. So according to the amount that they have invested into the organization, entity A is entitled to 70% of the 100 barrels of oil. And then entity B2 is entitled to 30% of the barrels that they produce. So it means entity A will take 70 barrels. And then entity B will also take 30 barrels. So in case during the year, entity A takes only 60 barrels of oil, it means that there is underlift of 10 barrels. And then in case entity B also takes 40 barrels of oil, it means during the year there is overlift of 10 barrels. So that's how underlift and then overlift occurs. So in conclusion, underlift occurs when you take less than what you're supposed to take from the organization. And then overlift to occur when you take more than what you're supposed to take from the organization. The next is we are coming to look at how to treat overlift and then underlift in their books. So in the books of underlifter, so underlifter is the entity who take less than what is supposed to take. The example that I gave earlier on, the underlifter will be entity A because entity A was entitled 70 barrels of oil and then he took 60. And then overlifter will be entity B. Entity B was entitled to 30 barrels of oil and then he took 40. So it means it has taken more than what it's supposed to take from the organization. So when it comes to profit and loss account, in the books of the underlifter, that underlifter will consider the extra barrels or the value of the extra barrels as sales, and then the overlifter will consider it as purchases. So let's assume that the extra barrels of oil that overlifter took, that's 10 barrels, and then the market price is 35. So 35, 10 times 35 will give us 350. In the books of underlifter, the underlifter will consider this 35 cedis, this 350 cedis as sales or revenue. And then in the books of overlifter, Overlifter will consider this same 350 cedis as purchase. And then, so these sales and then purchases will be recognized in the income statement in their respective books. But when we go to the balance sheet, that's the statement of financial position. Since overlifter has taken more than what he's supposed to take, it means that overlifter will be owing the underlifter. So in the balance sheet of the underlifter will recognize this 350 cedis as receivables. And then in the books of the overlifter, since overlifter has taken more than what it's supposed to take, it means it is owing the underlifter. So in the books of the overlifter will recognize it as payables, that's liabilities. And then the underlifter will consider it as a receivables, which is current assets or an asset. And then one thing about underlifting and then overlifting is the oil price will always reflect the current market price. So in case the current market price is 350 Ghana, it means the number of barrels that will occur at overlift or underlift will be valued at the market price. That's the 35 cedis. And then immediately the transaction took place, they will recognize it in their books. But at the end of the year, when they are preparing their financial statement, both income statement and then the balance sheets, they will value the quantity that occurred as underlift and then overlift at the current market price at the balance sheet date. Always the price that they value the underlift and then underlift quantity always varies depending on the current market price. So in case the day in which the transaction took place, the current market price for oil is 35 cedis. And then at the balance sheet date, the market price is 40 cedis. It means that the overlifter must to pay extra 5 cedis. The overlifter must to pay the extra 5 cedis. That's the difference between the oil price at the day in which the transaction took place and then the market price for oil at the balance sheet date. That's the date in which they are preparing their financial statement. So the difference between the 40 and then 35 cedis, the overlifter must to pay that extra money. So when the overlifter pays the extra money, in the financial statement of the underlifter, it will recognize it as other income. And then in the books of the overlifter, since it is paying extra money, it will recognize it as extra expenses or expenses in their income statement. So we take practical example to test our understanding on this. Entity A and entity B jointly control a producing property. A has a 70% interest and B 30% interest. At the start of the year, there is no overlift or underlift. During the first half of the year, production cost of 7,500 Ghana cedis are jointly incurred and 500 barrels of oil are produced. The cost of producing each barrel is therefore 15 Ghana cedis. There is no production in the second half of the year. During the first half of the year, A has taken 300 barrels and B has taken 200 barrels. Each sold. The oil they took at 32 Ghana cedis per barrels, and the market price at the time. So the market price at the time was 32 Ghana cedis. And entity A has underlifted by 50 barrels of oil, and then B has overlifted by 50 barrels of oil. The market price of barrels of oil at the end of the year is 35 cedis. So let's bring out the necessary information that will enable us to solve this question. So first, we start with the cost of production. The cost of production is 7,500 Ghana. And then the number of barrels of oil that they produce were 500. And then according to the question, entity A is responsible for 70%, and then entity B is responsible for 30%. So entity A, 70%, and entity B, 30%. And then entity B to 30%. So if you want to determine the number of barrels of oil that each of the entity must to take in according to their stake, we will just find for entity A, we will just find 70% on the 500, and then entity B, we just find 30% on the 500. So 70% times 500 will give you 350. And then that of entity B, 30% times 500 will also give you 150. So it means entity A is supposed to take 35 barrels of oil, and then entity B is supposed to take 150 barrels of oil. But according to the question, at the end of the year, entity A has taken only 300, and then entity B has taken 200. So it means entity A will become the underlifter because it has taken less than what it's supposed to be taking. Since it has taken 300, means there is underlift of 50 barrels. And then for entity B, it's supposed to take 150, but it took 200. So it means there is overlift of 50. There is overlift of 50. So me, in conclusion, entity A is the underlifter, and then entity B is the overlifter. And then the market price at the transaction day or the date in which the transaction took place was 32 Ghana cedis. That's the oil price at the transaction day is 32 cedis. And then at the end of the year or at the end of the reporting period, the oil price has increased to 35 Ghana cedis. Has increased to 35 cedis. So it means when they are balancing their books, entity B, the overlifter, must to pay the difference between the transaction price and then end of the year price to the underlifter. That's the entity A. So the difference between the two prices will give us 3 cedis. So it means the entity B must to pay extra 3 Ghana cedis on each barrel to entity A. That's the underlifter. So we are required to show how we recognize these transactions in the books of the underlifter, that's entity A. We start with the income statements of entity A. Entity A is the underlifter. Okay. So income statement is basically about your revenue and then your expenses. So we relate your expenses from your revenue to determine your net profit or net loss. So we start with the revenue. So the revenue will be the number of barrels of oil that entity A sold. So according to the question, entity A was entitled to 350 barrels of oil, and then entity B was entitled to only 150 barrels of oil. So our concentration will be on entity A since we are required to prepare income statement and then the balance sheet statement for entity A. So the revenue will refer the values at the transaction date, and then end of the year will refer the values at the end of the year. So we start with our revenue. So for revenue, entity A was entitled to 70% of the oil that they produce. So that's the 70%. And then they produce 500 barrels of oil. So 70% out of 500. And then the market price at the transaction date was 32 Ghana cedis. So times our 32 Ghana cedis. And it will give us 11,200. After that, we were told that the cost of production was 7,500. So cost of production the same as cost of sales. Since the cost of production was 7,500 and then entity A stake in the organization is only 70%, it means cost of production for entity A will be 70% of the 7,500. So cost of sales, 70% times 7,500. And then 70% of 7,500 will give us 5,250. So 5,250. So you less the cost of sales from the revenue to get your gross profit or gross loss. Okay, so gross loss will occur when the cost of sales exceed your revenue. And then gross profit will also occur when your revenue exceed your cost of sales. So the difference between, since our revenue is greater than the cost of sales, it means we will get gross profit. And then gross profit will be 5,950. So this is our gross profit. So after you have gotten your gross profit, we must to account for other income and then other expenses as well. And then according to the question, we were told that at the end of the year, there was an increment in the price of the oil. So oil price at the end of the year was shoot up to 35 Ghana cedis. At the beginning of the year or at the transaction day, it was 32 cedis. So it means entity B, the overlifter, must to pay the increment in price to the underlifter. That's entity A. And then the entity A will recognize it as other income in its books. So the difference between the two is 3 cents. And then the number of barrels of oil that entity B took as an overlift is 50 barrels of oil. So it will be 3 Ghana cedis time 50, which will give us 150. So it means entity A will recognize this as other income, and then if we are required to prepare the financial statement for entity B too, entity B will recognize this as expenses in its books. So we have other income. That's 3 times 50. So interim will be that, and then at the end of the year it will be 150. So with the other income will be recognized at the end of the year. So our net profit, there is no any further expenses as well. So it means for interim, this 5950 we got as our gross profits also serve as our net profits. And then for end of the year, our net profit will be summation of the other income and then the gross profit, which will give us 6,100. So in case at the end of the year, oil price, in case at the end of the year, oil price has dropped to 30 Ghana cedis, and then the beginning day or the day in which the transaction took place, the oil price was 32 Ghana cedis. So since there has been reduction in oil price, it means that these 2 Ghana cedis, that's a reduction in the oil price, will become extra expenses to entity A, and then it will become extra income. That's the other income to entity B, because the amount that entity B is supposed to pay to entity A has been reduced by 2 Ghana cedis, and then the amount that the entity A is supposed to receive from entity B has been reduced by 2 Ghana cedis. So it will become a loss or expense to entity A, and then it will become a gain to entity B. So let's look at how the financial statement for entity A will be like. So we are done with the income statement. So let's look at how the income statement, the balance sheet statement for entity A will look like. So since entity B is owing entity A, that's the value of the overlift. Entity A will recognize it in its books as debtors or receivables. And then in the books of entity B will recognize entity A as payables. And then we are required to record a transaction in the books of entity A. So in the books of entity A, entity B is receivable or debtor to entity B. We only record the value of overlift that it occurred. So at the interim date or the day in which the transaction took place, the value of oil or the price of oil was 32 Ghana cedis. So that's what we use to calculate the interim figure. And then at the end of the year, there was an increment in oil price. So the price was increased to 35 Ghana cedis. So we use the 35 Ghana cedis to calculate the amount that the entity B is supposed to pay to entity A. So we can direct. So receivable. So receivables. Entity B is only owing entity B the value of 50 barrels of oil. So 50 times 32 will give us 1,500. But at the end of the year, the price was increased to 35. So it means the amount that the entity B is owing entity B will valued at 35 Ghana cedis. So at the end of the year, one will be 50 times 35, which will give us 1,750. So there is a difference of 150. This is what we recognize in the income statement as our other income. So that's all about overlift and then underlift. We are done with accounting for oil and gas. In our next class, we will start cash flow statement. So, but in case we want any further explanation on what we have done, you can WhatsApp us or call us on 0249-220363. And then we provide private tuition as well, face-to-face classes, one-on-one classes. If you want our service, WhatsApp us or call us on the same number. See you in our next lesson.